Hello everyone, my name is Simon MacAllister, Strategy and Transactions Partner with EY. This is one of a series of videos where I'll chat to some of my colleagues to share what's going on in the market, giving you an up-to-date view on what's happening and things to watch out for as we enter 2023. Today I'm talking with David Martin, Strategy and Transactions Partner and leader of our debt advisory practice. Thanks for joining me today, David.
Thanks, Simon, and great to be here.
So one of the big financial stories of 2022 was the interest rate story. What has it meant for new debt issuances?
Yeah, I think in Ireland, undoubtedly, debt issuances are down, and that's probably been driven by three main factors. The first is lenders are taking much longer to make decisions, so there's an elongated decision-making process. The second is borrowers are struggling to raise debt at the terms and conditions they previously had. So effectively, borrowers are reappraising whether or not they're going to do their acquisition or they're going to do their capex plan that they had planned previously. So all of those things are pushing things on and making debt issuance go down in 2022.
Okay, so an awful lot happening. I mean, and you mentioned terms and conditions there. Outside of the main interest rate, headline rate, what are the kinds of impact on terms and conditions borrowers have seen?
Yeah, I think that kind of heightening interest rate has led to an array of changes in terms and conditions. I mean, the first thing we're seeing is deals are taking longer to do. So debt transactions are certainly taking longer. The banks and lenders are focusing on existing borrowers more than they are on new business. So again, if you have a new business transaction or proposal going to a lender, it's falling behind the existing borrower. And then the last thing is the diligence that banks and lenders are doing is taking a lot longer, and that's leading to much tighter financial and information covenants. And then the last thing we're starting to see in 2022 was alternative lenders themselves are struggling to raise debt, and that has an element of uncertainty which is passed on to the borrowers.
Okay, very interesting differentiation on the new against existing borrowers, so probably one for people to be aware of. I won't ask you to call the top on interest rates, but what would you expect to see in 2023?
Yeah, I mean, that's obviously a tough one, but certainly what we've seen the last decade is unprecedented low interest rates, and that's allowed businesses to fund their growth through cheap debt. That's changed the last year. So I think, the geopolitical things that are going on at the moment has led to increased inflation. Central banks had to take action. They had to raise interest rate so you could meet the inflation guidelines or objectives they have. So there's been a bit of good news in the last few weeks around inflation, but still most commentators are saying there'll be an element of increased interest rates over the next 6 months.
Okay. So what should borrowers be thinking about?
Yeah, I think, look, the big thing for borrowers, and it's not all negative out there, there's still a huge amount of debt options in the marketplace. But what we'd be saying is get your plan done early. Think about all the options in your plan and go to the lenders early so you're at top of that queue, because that's going to be really important in 2023.
Okay, some great insights. Thank you very much.
Thank you, Simon.
If you have any questions on what we discussed today, David's details will be included along with this video. Keep an eye out for the next episode from our Strategy and Transactions team.